Good afternoon and welcome to the Alterna Wealth Market Update Call. Thank you so much for taking the time out of your day to attend this call. My name is Nathan Halawushka and I am the Vice President of Sales here at NEI. I will be the host for today's call. Joining us today is Sean Kimji, VP of Wealth Management at Alterna, and John Bay, Chief Investment Officer at Aviso Wealth and NEI Investments. I just wanted to run through a few housekeeping items very quickly. With respects to everyone's time, we are aiming for this call to be promptly half an hour. Like I mentioned earlier, we have put everybody on mute, and I do ask that everybody does keep themselves on mute for the duration of the call. For the best viewing option, in the top right-hand corner of the screen, you'll see something that says speaker view or gallery view. I do suggest switching to speaker view, as this will allow you to focus in on who is speaking. With that being said, I'm going to pass it over to Sean.
Thank you, Nathan. I hope all of you can hear me well. It's wonderful to have you all join us on this call today. We are the co-hosts with NEI, and we're certainly pleased to bring you this market update for today. There are a number of questions that I'm sure you may all have. We've seen a lot of turbulence and changes over the course of the last number of months with respect to the COVID-19 pandemic, the market downturn and subsequent, I guess you could say, rebound, to political turmoil and unrest. And we thought it would be wonderful to have our CIO, John Bay at NEI Investments, to provide a market update on some of the factors that are influencing global markets. But NEI is also a responsible investment leader, and you know what responsible and sustainable investing means as it relates to investment management. And I'm sure you all want to know the question, what is the outlook going forward? We did receive a number of questions. I really appreciate all the questions, and we won't be able to get to all of them. But John has a presentation which he'll be addressing some of these key items that we've asked, and then I will run through some of the questions towards the end of the call. With that, I'll do a brief introduction of John. John joined NEI in May of 2019 and has been actually in the industry for more than 25 years. In speaking with John, I mean, I've had a number of calls with John, and he has an incredible wealth of knowledge. He's very well versed in the markets. He is the Chief Investment Officer at NEI, obviously, which is an extremely large and successful fund company. And, I think we're very lucky to have John and his time on this call today. So with that, John, I'll pass it over to you.
Sean, thank you so much. Good afternoon, everyone. Thank you so much for taking time out of your busy day to be with us today. As Sean mentioned, we have a lot to cover, but we hope to do so in a very succinct and insightful way. As Sean mentioned, this 2020 has really ushered in a decade of many crises or crises. It's not just a global pandemic and COVID-19, which is a healthcare crisis. It's the economy has been shut down, which is an economic crisis. It's also revealed a crisis in our most vulnerable peoples, and I'm thinking of the senior citizens of our country. We're also dealing with a climate crisis that we need to get moving on. And in the last couple of weeks, we've also witnessed a social justice crisis as protests across not just the United States, but across globally is really challenging our views and trying to, again, push forward agenda of a more inclusive society. So 2020 is really proving to be a challenge of our generation. And as we look forward to the future, I hope that we will be able to look back and say that, in the words of my favorite Canadian, former governor of Bank of Canada, John Carney, that we've created a country that is more sustainable, more inclusive, and more prosperous in the decades ahead. So with that, let me just run through a couple of quick slides before we get to our the COVID market update. Nathan, if you can go and do your screen share, that would be great. Thank you very much. So if we can just go to slide 2, I just have a couple of slides, just do a quick introduction of our company. Aviso Wealth is one of Canada's fully integrated wealth management companies in Canada. It really is a product of three large established businesses, a full service brokerage, a online brokerage, as well as an asset manager. The company has a 30-year plus history, managing relationships with 300 financial institutional partners, as well as combined assets of over $60 billion. Next slide. And so I'm part of the NEI organization, which is the asset manager. And with that, we've chosen to partner with some of the largest and most well-respected investment managers in the world. We have 17 external investment managers. They collectively manage $6 trillion and have offices in 100 offices around the world. I like to say that we are a company with $8 billion of assets under management, but we have the investment resources of $6 trillion of our sub-manager relationships. NEI has a long and proud history in responsible investing, as Sean mentioned. Many asset managers are now just getting into the responsible investment game, but this is not a fad for us. This is something that we've been pursuing for the last 30 years. NEI launched Canada's first responsible investment product 30 years ago, and we've been on the forefront of product innovation in responsible investing for the past 30 years. So with that, so let's move on to our market update. And so when I think about the COVID-19 crisis, I really divide it into three phases. First was the crisis that we saw in March globally, then the response, and then the third phase is the recovery/rebound that we are currently in. And so when I think about the first phase, the crisis phase, it can really be described in two words. It was quick and it was steep. And everything about the COVID crisis was quick and record breaking. It was how quickly the virus spread, how quickly the market fell, how quickly the economy was shut down, and how quickly money was pulled out of the markets. And it only took 6 days for the S&P 500 to fall from record highs on February 19th into bear market a category, which is widely defined as a pullback of 20% or more. That was the fastest descent in history. On the chart on the right, you will see asset class returns in Canadian dollars from January 1st to March 23rd. And you'll see that Canadian equities was one of the hardest hit areas, as in Canada, we were really dealing with two crises, not just the COVID crisis, but also the oil crisis, when Russia and Saudi Arabia were not able to agree on output cuts, which in April culminated in something I never thought I would see in my professional history, negative prices on oil prices. We've pulled out since then, and there's been some market correction, thankfully. But that's some of the things that Canada has been dealing with. The other thing you'll see is that value equities are, defined as a value versus growth, was the second hardest hit after Canadian equities, followed by international. And U.S. has done very well. And typically, what you see in periods of crisis, U.S. dollar did quite well as a safe haven asset, and that's exactly what happened during the crisis as well. Next slide. So the response, the second phase, the policy response was record-breaking and quick as well. To date, $9 trillion of fiscal stimulus has been announced globally in less than 2 months. We've seen the fiscal support announced by the G20 countries already exceeding the levels that we've seen during the global financial crisis. Central banks' response has been quick as well. Both the Bank of Canada as well as the U.S. Federal Reserve has dropped interest rates to zero, and again injected incredible amounts of capital into the economy. If you look at what the U.S. Federal Reserve has done, and I plotted the Bank of Canada as well as the Federal Reserve balance sheets on the right-hand side. The Bank of Canada, the Federal Reserve is in blue, and you'll see that their balance sheet expanded from $4 trillion to over $7 trillion over the last 2 months. And the Bank of Canada, we really didn't have to do very much during the 08-09 crisis. For those of us who remember, the global financial crisis really did not hit Canada as hard as some other parts of the globe, including the U.S. But today, the Bank of Canada has been very aggressive, expanding its balance sheet, injecting capital into companies that need it to survive, this crisis, from really 125 billion to almost 470 billion dollars. So again, they've been very quick to ensure that we have enough monies and liquidity in the system and enough capital in the system to bridge the gap to help people and firms to get through this crisis. And to date, they've done a brilliant job. And one of the reasons why we're seeing such a quick rebound is because of the aggressive stance that policymakers have made over the last couple of weeks. Next slide. And so, as I start to think, with the recovery stage, COVID-19 was really one of those black swan events, but really, it only really accelerated the themes that were already in the marketplace. Specifically, there are four trends to pay attention to in the decade ahead. As I think about them, number one is that the future is smart. And this is really the transition from a physical to digital economy. Online sales of U.S. consumer product goods leaped an unprecedented 91% in March. And Canadian and U.S. post offices just can't keep up anymore because we're spending less time at stores and buying more stuff online. And COVID-19 only took this trend to the next level. The future is clean. And this is the transition from a high carbon society to a low carbon economy. The world in 2050, according to our scientists, will be hotter, wetter, less fertile, and less diverse. And climate change is real, and it's a real threat to our global economy. These risks include physical risks like forest fires, storms, and flooding. In Calgary, in southern Alberta, really saw that on the weekend. And those types of storms are going to increase in the years ahead. But they also include transition risks for big energy companies in Canada to transition their business from high carbon intensity to low carbon intensity. The future is also more resilient. This is the transition from vulnerabilities to the ability to withstand increased exogenous shocks. For decades, companies have really subscribed to the notion that the corporations existed for the sole benefit of their shareholders. But COVID-19 has really exposed the downfall of that business model. Companies that maximize shareholder returns, really have ignored risks in their business model, including financial risks, employee risks, supply chain risks, changing consumer preferences risks. In a world where exogenous shocks are going to keep increasing, companies need to pay less attention to things like short-term profits and pay more attention to building long-term sustainable business models. And the future is fair. And so the question I ask here is bigger always better. This is how we got into trouble in the first place. If we export all of our manufacturing to China, we get cheaper toasters and calculators, but that has impacted the ability of a vast majority of our population to earn living wages. We went from a country that had high, stable paying jobs to low paying gig economy jobs. And we need to make sure that we are assuring more fair distribution of wealth and the opportunity to make a living wage. In the recent protests of also raising the bar for companies on that social level. So my thesis really is that when we headed into this economic recovery stage, that it would be slow and measured, not quick and fast. And I thought that the economy would open up, but in phases. The market will recover in stages, and people will emerge from the lockup, but it would take a while to do so. But let's turn to the next slide, and we'll see what happened. And we'll see here that that the markets bounced back pretty quickly, but it was a very narrow bounce back. And what I mean by that, by July 10th, the S&P 500 was back to break even on the year, but really that rally was contained to only the 5 largest stocks in the S&P 500. These are technology companies that we all know and love: Apple, Amazon, Microsoft, Alphabet, and Facebook. But if you look, they had an average return of 10% to the end of May. But you look at the other 495 companies, they had an average return of negative 15.5%. So a big dichotomy between the companies that performed well and the companies that didn't. And again, value stocks lagged growth stocks by more than 20% from the beginning of the year to the end of May. Next slide, please. And so, having said that, this crisis has really provided an opportunity to speak to the themes. And so that first theme, that transition from physical to digital, we've seen that in the recovery in the bounce back of technology stocks. Now I'm going to address the themes of cleaner, more resilient, and fairer, and that's really involved and wrapped up in this thing we call responsible investing. So what is responsible investing? Broadly speaking, responsible investing is a investment style that takes into consideration not just financial considerations, but more than that. So it's not just enough to find a company that's short-term profitable, but a responsible investment investor will ask questions around E, S, and G. E is the environment. Is the company a good steward of the planet resources? Clear-cutting forests, for instance, would not make the cut. S is social. Does the company have good relationships with its clients, its employees, its suppliers, and the community it operates? Making clothes and sweatshops would not make the cut. G is governance. Does the company have good governance principles? And so, for instance, and do they have good governance factors that will influence the business strategy on a go-forward basis? So, for instance, last week or 2 weeks ago, we asked Google in a shareholder resolution to have a governance strategy in place to meet basic human rights of their users of their Google product, including privacy of their users. So ESG makes good investment sense, and it really does reduce the risk that you're taking in your investment portfolio. What I've done here on the left-hand chart is map the last 3 major market pullbacks and the percentage of RI indices, responsible investing indices, that outperformed non-responsible investing comparable indices. And you'll see in each of the 3 market pullbacks that responsible investing did much better. And because by factoring in non-financial information, we've been able to reduce the risk for investors. Next slide. I want to maximize the time, sir. So let's skip these next 2 slides. Yeah, next slide as well. So let's move on to the investment. Nope, go back. Thank you. The economic recovery. So really here, as we start thinking about the economic recovery, the IMF put out a forecast. They're looking for the globe to pull back -3% in 2020, with a much faster rebound in 2021 of 5.8%. And so, on a quarterly basis, which I think is really important here, we really think that economic activity hit a bottom in April or May of this year. So basically the second quarter of the year. We think that economic activity will pick up in the third quarter, and it will be higher in the fourth quarter, and us returning to a more normalized scenario sometime in 2021. So with that gradual recovery in economic activity, we believe that economic recovery will be supportive for company earnings, and therefore supportive of the equity markets on a year plus time horizon. So when we're looking at our investment portfolios a year from now, our thesis is that the economic activity and earnings will be much higher, and therefore that we expect returns of the equity markets to be back at their long-term averages in the high single digits. And so next slide, please. So when we think about that in terms of asset classes, we take a look at valuation charts on the right-hand side. You've seen that in the first chart that the U.S. has done much better than some of the other areas of the world, and therefore, looking at long-term average valuations, that dot over USA is over the box, which means that they're extremely high valuations according to its long-term average. Where we're seeing other regions such as Canada and Europe, emerging markets, to be at much better valuations, and therefore, valuations would suggest that would favor Europe, Japan, and emerging markets over U.S. markets. On the fixed income side, with 90% of government bonds now yielding less than 1%, you'll see that the 3 dots over the valuation boxes, meaning they're much higher than average value, the long-term averages, are all government bonds. And we certainly see much better valuation in corporate bonds, including investment-grade corporates and high-yield corporates over government bonds. Next slide. Yes, and so this would just support the position I've just made, that government bonds are at the low end of their 10-year range. On the left-hand side, I've plotted the G7 countries. You'll see that Canada, high of 10 years ago at 375, now well under 1%. Germany is in fact actually negative, and the U.S. is in the same range as well. And on the right-hand side, you've seen high yield spreads, again, very risky. So I wouldn't have a large percentage of my portfolios allocated to this, but you'll see that just how elevated they are versus long-term averages, and why we think there's attractive opportunities there as well. Next slide, Nathan. And so, of course, every investment outlook comes with risk factors, and the success of this, is dependent on whether or not it's an unusual period, in the sense that it's not just an economic recovery is really dependent on how we do as a society and the healthcare crisis that we're dealing with. And so we're assuming that we will be able to reopen the economy, and that we will be able to bounce back after a period of shutdown. And thankfully, the short-term bounces that we're seeing in employment and in retail sales are supporting that view, at least in the short term. So with that, Sean, is a quick rundown of the investment landscape, and I'll turn it over to you for questions.
Thank you, John. Excuse me. A lot of information packed into that, and a lot of material to digest. We did receive a number of questions, and I tried to focus some of them into similar themes. And I guess what a lot of folks have been asking, John, is, we are seeing the markets open up. We're seeing a loosening of restrictions, but we're also seeing a potential possibility of a second wave of viruses, or a potential increase in infections that may come in the fall. And so what are your thoughts of that impacting the markets and having another market low? The possibility of another lockdown if infections increase. Could you provide some comments on your thoughts regarding a potential second wave and what that means to us?
Yeah, no, that's a really important question. And, we are seeing some worrying signs globally as daily new cases reach new record highs over the last weekend. And, certainly in the States, we're seeing Arizona, and this is really instructive. They've opened up their economy on June 1st, and we're seeing a surge in new coronavirus cases there, over 4,000 in 72 hours. And their infection rates, are now higher than New York, 60 cases per 100,000 versus New York, which is only at 12 cases per 100,000. So, is this related to opening up the economy? Probably. Before the stay-at-home, when the state was in a stay-at-home lockdown, only 5% of tests were positive statewide. Now it's close to the 12%. But but I'm not sure we need to hit the panic button just yet. And for a couple of reasons. Number one, we are better equipped to deal with this crisis from a healthcare perspective. Shutting down the economy was harsh medicine for sure, but it gave us time as a country and a province and as cities to prepare for this health crisis. We have processes and procedures now in place. The front line is now better trained, and they know what to do with better protocols. And we've had time to source, valuable equipment that we were short of. For instance, personal protective equipment or PPE, as well as ventilators. And so, from a healthcare perspective, we are much better equipped for today than we were even just 2 months ago. We're also better equipped as a society. We know how to slow this down. We need to wear masks, not so that it prevents us from getting the COVID-19, but the masks really there is to prevent the spread of COVID-19 in case I have it to the people around me. Also social distancing measures and washing our hands. So we also have more tests. So even the US, which started out of the gate, just unequipped to deal with this healthcare crisis, they are now testing 75,000 tests per million people. And the gold standard in March was really South Korea, which was 10,000 per million. And so they're way above that level. So we have much more tests. And so, I think that there are concerns of a second wave. I think as a society, we are better built to deal with the second wave. And we'll see how it goes, but we have to remain vigilant for sure. In terms of reaching that March 23rd low, I am not thinking that that will be my base case scenario. The reason for that is that I think the economy will continue to open and support earnings. The second thing is that there is so much cash on the sidelines here. And really, even on the institutional front, which traditionally gets into the markets before retail investors, they are still near record highs in terms of cash. And so every time the market pulls back, you're seeing institutional money go into the markets because as markets rise, they're feeling the pain of not being invested. So for those two reasons, I think that right now, I am my base case scenario is certainly not revisiting of the March 23rd lows.
Great, thanks. You had mentioned in your presentation that there's been a lot of fiscal stimulus to help support the economy and inject liquidity. We're hearing, in the media that the government cannot afford to continue to do this, and that there's significant debt levels. Can you comment to the ability of governments to continue to provide fiscal stimulus and what that means?
Yeah, no, thank you. That's a really good question because that was a really big theme for those people who remember in the global financial crisis. And in one of the big studies that were going around on the time was really saying that 90% was a really critical level of debt to GDP levels. That once governments and countries got their debt levels above 90%, that economic growth slowed considerably. And that was one of the reasons why you saw all those harsh austerity measures really kick in during the global financial crisis, and the lessons learned from all of that was that austerity does not work. It actually makes it worse. And so debt levels are an important factor, and we definitely cannot increase debt in an unconstrained manner. Having said all that, why is that bad? Because it increases your interest payments, and that's just unproductive. So that just reduces the monies that are available to invest in your productive assets, as a country, for instance, your infrastructure, energy, education, et cetera, et cetera. But they are, so I'll say three things. Number one, increased debt levels during this crisis was absolutely necessary for us to bridge the gap from to get people through the economic shutdown and into a recovering economy. If we did not do that, the economic landscape, the recovery that we're seeing over the last couple of weeks would not be as quick as we possibly had. We had to bridge that gap, and the governments had to get involved, and it was absolutely necessary. There's number two is that we're in record level interest rates, and so despite the fact that these debt rates are going up, when you look at Canada in the 1990s, when our debt level was greater than 100% of GDP, interest rates were like 8% on the 10-year bond. Today, it's now less than 1%. So, I think that as a country, governments are still able to borrow, and the U.S., for instance, has increased their balance sheet by $2 trillion, and interest rates on that has gone down, not up. And so they're able for now to support that increased debt without increasing the interest payments that have to go on. But it's certainly something worth watching. Canada problems. In the U.S., part of the problem during the global financial crisis was that households in the U.S. had extremely high debt levels because they were buying houses, and when that came crashing down, we know what happened. So over the last 10 years, the U.S. households have actually dramatically decreased their debt levels, and but Canada's kind of done the opposite. Over the last 10 years, we've only increased our household debt levels, and so we need to be really careful about that. But we'll see how that plays out. So, I think that debt levels are a concern at the government level, but absolutely necessary. Interest rates levels are mitigating that impact, and we need to get through this crisis.
Thanks, John. Folks, I know we're approaching 4:30. We've had many questions, and we will endeavor to respond to each and every one of your questions. I do want to say that, if you have a comment or feedback that you'd like to provide us, you can always send it to wealth@alterna.ca. And subsequently, if you'd like to speak to a wealth advisor, have a portfolio review, or have any additional questions or feedback, you can also send that to wealth@alterna.ca, and we will certainly get back to you. We will have this as a recording, audio recording, which will be posted to our online resource hub in the next couple of days. So again, you can come back and link to it and view it. And John, I believe you had another comment you wanted to make there, just quickly.
Yeah, just very, very quickly, I just wanted to thank everyone for their time today, and I just wanted to just sum up everything that I've said. That that we are now expecting with the economic increase in economic activity that we remain constructive on the markets. But in times of stress and uncertainty, we would certainly support Sean's message of the need to talk to a financial advisor to make sure that your investment portfolios are positioned properly in the months and years to come.
Thank you, John. And thank you all for joining us on this investment webinar. Nathan, I'll hand it over to you to close things off.
Great. Thank you, Sean. Thank you very much, John, for your attendance. This webinar was extremely insightful, and I think everybody did learn something new today, and we're going to be able to take it away and internalize it, and would definitely be coming to our advisors for a review of the portfolio. Thank you very much, everybody. And like Sean said, the video and audio recording will be available shortly.
This material is for informational and educational purposes and is not intended to provide specific advice, including, without limitation, investment, financial, tax, or similar matters. The views expressed herein are subject to change without notice as markets change over time. Information herein is believed to be reliable, but NEI does not warrant its completeness or accuracy. This material is not intended to provide investment, financial, accounting, legal, tax, or other professional advice and should not be relied upon or regarded as a substitute for such advice. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments. Please read the prospectus before investing. Mutual funds are not guaranteed, their values change frequently, past performance may not be repeated. For complete information about a mutual fund managed by NEI Investments, please refer to the fund's simplified prospectus and/or fund facts, which can be downloaded at www.neiinvestments.com.